Hi everyone, so welcome to the stream today. Really excited for having you on the second episode in our IFRS masterclass towards the March 2024 examination, and we are looking at the IAS 33, that is earnings per share, and we want to continue with the discussion from where we left on Monday. So in case you missed the first session, you can check the playlist, the IFRS masterclass playlist on the channel, and you'll be able to watch the video and get access to the entire content so that you can be assisted much better to be able to prepare well and pass the examination. So I see some of you guys joining. You are welcome. Give me a thumbs up on the video when you joined. And if you know there is somebody writing financial reporting or corporate reporting who needs to know about this course, this lecture, and watch this video, then you may consider to share the video with them so that we can reach as many students as possible. But also, if there are any questions you have for me, you can put it in the comment section or the chat box. I'm going to be reading all your comments and will be answering your questions as well as we proceed in the discussion for the day. So we are going straight up into it. Let me bring up my slide quickly and then let's get excited into the discussion for the day. What do we have? There we go. So in the part one, we looked at the fundamental principles on earnings per share. We discussed the importance of earnings per share to the investors. We also talked about the importance of earnings per share to the various people. So we discussed the various things that the earnings per share tells us about, but then we also discussed the issue about the limitations of the earnings per share, all that in the part one of our discussion. Give me a sec. I think my slide is look like being delayed here. Let's see if I can pick it up. Okay, yeah, there we go. So we looked at the fundamental principles when it comes to dealing with the earnings per share, but we spent our time to look at the second part, which is a potential issue, and that is the diluted earnings per share, discussing the principles when it comes to dealing with the diluted earnings per share, talking about the share options, and also the issue about convertible loan notes. And so, what we want to start with today is a question which will bring together the two principles so that it helps us to really understand how we apply the two principles in a very examinable question in the discussion. So, this is the question that we are starting with. You can take a screenshot of it. It's an ICAG past question, that is the Institute of Chartered Accountants Nigeria. They are question on financial reporting here, and so we want to look at this question. Let me take a screenshot and then we're going to be going into this one here. So the requirement here is to, most importantly, calculate the diluted earnings per share, but there is something here to rank the potential ordinary shares. Because remember, like we said on Monday in the first episode, we mentioned that there is going to be issues in respect of the potential, because the share options and the convertible loan notes have potential of giving us new shares. So how do we do the ranking? We're going to be explaining that generally in the discussion today. Then we will look at the calculation of the earnings per share. So let me bring the question here so that I don't have to be moving through my slide back and forth. Okay, so let's read the question, see what we have here. The following information relates to Jumai Nigeria Limited for the year ended 31st December 2020. Ordinary shares of 50 kobo. Now remember, this is a Nigeria environment, so this is 50 kobo each, and it is valued at 3 million naira. 50 kobo each, value at 3 million naira. So the first thing we need to ask ourselves is, what is the number of issue shares outstanding? Okay, so issue shares outstanding, that's going to be 3 million naira divided by the 50 kobo, and that is going to be 0.5. And so we punch that out, 3 milli 0.5, and that's going to be 6 million shares. So the issued shares outstanding at the beginning of the year, it's 6 million shares. So that is the first thing we do. Number two, profit for the year is given to us as 18 million naira. So the profit for the year is also given to us 18 million naira. So as always, although we are supposed to calculate the diluted earnings per share, we have to calculate the basic earnings per share. As always, that's the starting point. So let's calculate the basic earnings per share. Let me just go this way. Basic EPS. And that is going to be the amount given to us here to be 18 million naira. And that is going to be divided by the number of shares we have, which is 6 million. And so 18.6, that's going to be 3 naira. Okay. That's 3 naira. So the basic earnings per share is 3 naira. Okay. So once we have the basic earnings per share, we can now start thinking about the diluted earnings per share. So let's go back into the question, and then we're going to pick the items up from the context of the question. Average share price, average market price of shares during the year was 70 naira per share. So we need the average share price. We don't know what is happening. Let's go. The potential financial instruments in existence in the company are detailed below. The potential financial instruments in existence in the company are detailed below. So that's the potential. So let's go. First, we have 800,000 options with exercise price of 52.5 naira. Okay, so this is options. If you remember the principle under the options, we said we calculate the percentage of dilution, then we are going to be calculating the number of shares in the options, then we can now calculate the number of equity shares generally under review. So I am going to just present my answer this way generally. So we're going to be having the company coming up. The company's name is Jumai Nigeria Limited. All right, that's better. So we're going to have the earnings, and then we're going to have the number of shares, then we're going to have the earnings per share coming in. So I'm going to just present in that horizontal manner. So earnings, then we'll have the number of shares, then we'll have the earnings per share coming up like this. So earnings will definitely be in naira. Okay. Number of shares, this also comes in as naira in that particular case. So let's go into the discussion then. So let me pull this up a little bit. So let's go. Now we start with the basic issue. So in the basic earnings per share, as we did earlier, there is 18 million. So we pull it up. 18 million. The number of shares given is 6 million outstanding from our calculation. And so that gives us a basic earnings per share of 3, if you remember from the basic earnings per share calculation. So now we bring in the other items, what we just read, the options. So in the option, remember, we said the share options have no effect on the profit for the year. So there's not going to be any effect on the earnings. But the question we need to ask ourselves is, what is the number of shares in the option? So that is where we need to go and do the calculations for the number of shares. So workings, let's look at the number of shares in the option. So first, we calculate the percentage of dilution, if you remember, and that is going to be the share price. In the question, we are told that the average share price is 70 naira. So that's going to be 70 minus the exercise price. In this question is being given to us directly as 52.5 naira divided by 70 times 100. So let's punch this out to get a percentage of dilution. 70, 52.5, 70 times 100. I'm getting 25%. So that's the percentage of dilution. Once we have the percentage of dilution, we can then calculate the number of shares in the options. And that's going to be 25% of the share options, which is 800,000 options. And so 25% of 800,000, that gives me 200,000 shares. So the number of shares in the option will be 200,000. Okay. Again, you realize that I tell you this always. I read, then I work. I read, then I work. I read, then I work, because that is going to be crucial for us in order for us to actually put all the pieces together generally, because that's going to be crucial. So we bring the 200,000 here. That is the number of shares in the option. Remember, it has no implication on earnings. So our adjusted amount, if we want to calculate, is still going to become 18 million. So our earnings is still going to be 18 million, but our number of shares will now be 6.2 million. So let's calculate the earnings per share diluted, okay, for the share options only. So diluted earnings per share, and we are dealing with just the options here. Let's punch it out and let's see what we get. Let's see if I can slide this up a little bit. So what do we have? That's 18 milli. A lot of zeros here. 18 milli. Sorry, 18 milli divided by 6.2. Okay, so I'm getting 2.9 naira. Okay, 2.9. Now that is dilutive, because as you can see, the share price, the earnings per share has reduced. So we are, again, like we discussed here in episode 1, what we are telling shareholders is, hey, listen, now you are making 3 naira. But wait till this share option people exercise their option. And if they exercise their option, boom, it's going to become the issue in respect of the 2.9. So that is the diluted earnings per share only. Okay, the diluted earnings per share only. Then let's continue to read. II. 5% convertible bonds. Oh, of 6 million naira. Now, bonds affect the earnings, if you remember, because what we are saying here is that we are going to assume that the bonds have been converted at the beginning of the year, and hence whatever interest that is supposed to be paid will not be paid, and for that reason the tax benefits to be received will also not be received in that particular case. All right, so let's bring that into my flow. So we're going to be bringing in the convertible bonds. So in the convertible bonds, it is going to be affecting earnings. We will do the workings for that. Then we will calculate the number of shares as well. So let's come back to our workings flow. This one was for the share options. And this is for the bonds. Convertible bonds. So we want to look at the benefit, the earnings effect that will come here. So the interest, remember we're working in naira, the interest is going to be, they said 5%. So that's going to be 0.5%, sorry, 5% of the nominal value of the bond, that is 6 million naira. So 5% on 6 million naira we're getting 300,000. But we need to subtract the tax effect on it. So we less the tax benefit there in that particular case. Then the tax benefit in the question, we are told that the corporate tax rate is 30%. So 30% on this, on the 300,000, that's going to give us 90,000. So the net interest that we are going to be adding back to our earnings is going to be 210,000. Okay, the net interest is going to be 210,000. So that is going to be coming into the picture. So if I come back to my slide, the convertible bonds from working stew, we are adding 210,000 on the earnings part. Okay, because we will add that to the earnings. Then let's find out about the number of shares we can get in the convertible loan notes. So number of shares. Let's go back to the question and see the conversion policy. They said that each bond is convertible in year 2025 into ordinary shares at the rate of 30 new shares for every 100 naira bond. Again, remember, we don't care about the date of conversion, because we are assuming that they have converted at the beginning of the year. That was the assumption we established in episode 1, right? So 100 naira, 30 new shares. So the number of shares is going to be, the total nominal value here is 6 million divided by 100 naira times 30 new shares, because you get 30 new shares for every 100 naira. So we work that out arithmetically. 6 milli over 100 times 30, and I'm getting 1.8 million shares. So 1,800,000 shares. So from the convertible bonds, the shares potentially in that is 1.8 million. So that 1.8 million shares will be added to the number of shares column. So 1,800,000 here. Okay, so now we can get a restated amount that we can use to do our calculation for the earnings per share, and that is going to be 1.8 plus 210, and that is 1821. 1, 2, 3. Then on the share options, we have 1.8 plus 6.2. That's going to be 8 million. I think I'm enjoying the zeros. That's 8 million. So now that we have the restated amount, we can then calculate the diluted earnings per share. And that is for both the bond and the share options. And so in that case, we do the division. 1821 divided by the 8 million, which is now our weighted average number of equity shares, and that is going to give us an amount of 2.2. Sorry, let me take this again. 18. No, this is 18.2. Sorry. Let me take that again. So that would be 18,210,000. All right. So let's punch that again. 2,010,000 divided by 8 million. Okay. So I'm getting 2.28, something like that. Again, that is also dilutive. Okay. Because it is going to affect our earnings at the end of the day. So you see the way I'm doing the presentation. Now, this is a different format of presentation from like what we did in the episode 1 where we were doing the calculation and doing this is another way we can do our presentation. All right, so the earnings per share is dilutive, and then the bonds now into the earnings per share is also going to be dilutive. But we are not done, so let's continue to read the question. III says we have 200,000 8% convertible preference shares. 200,000 8% convertible preference shares. Now, although it's a convertible preference shares are not considered as dilutive. So although it may result into the reduction in the earnings per share, it is not really considered as dilutive. Nonetheless, we will flow with the workings. So we have an 8% 10. So let's do the workings here. So we have workings 1 for the share options, workings 2 for the convertible bonds. We go to workings 3 into the convertible preference shares. So let's go pick up the items again. 2010. So the nominal value is going to be an amount of the nominal value will be, they said 2,000 times 10 naira, and that's going to be 20,000 naira. In that particular case. Then the interest rate there is 8%. Again, we are assuming that they are making payment. So interest. And here it's not necessarily interest like dividend we are paying to them. So 8% on that particular amount. Oh, sorry, it's 200,000, not 20,000. Come on now, Nhyira. Can't be mixing the figures now. Let's take 200,000. Okay, so this is supposed to be maybe 2 milli. All right. So 200,000 by 10. Yeah, 2 milli. So we take 8% of 2 milli. 0.08, and that is 160,000. Again, it's interest potentially, so we can say that, hey, we're gonna lose what the tax benefit of that generally, so we will less the tax from it. So the amount, the net benefit, it's going to be taking 70% of this figure. Why? Because remember the tax rate is 30%. So we take 70% of this figure, and that gives us the net benefit of 112,000. Now, stay with me. Like I said, when it comes to preference shares, dividend to preference shares is not a P&L item. Okay? It is done in the statement of changes in equity. So it doesn't affect the profit for the year. So really, preference shares don't bring about dilution. So really, we will not get tax benefit for this particular item here, because the amount that is paid to the preference shareholders will be treated in the statement of changes in equity. So we can still pull it up generally and bring it in the flow of our workings. So convertible preference shares. On earnings side, we'll bring 112 there. Then on the number of shares, what is the conversion policy? They said each preference share is convertible in 2024 at a rate of 1 new ordinary share for every 25 preference shares. 1 new for every 25. Okay. So number of shares that they are likely to get, it's going to be the 200,000 divided by, let's take it again, at the rate of 1 ordinary share for every 25. So 200,000 divided by 25 times 1 ordinary shares. Okay? So we punch that out. 200,000 divided by 25. And that's 8,000 shares. So the number of shares that the convertible preference shareholders will get will be 8,000. So we could, like I said, bring that up. So the adjusted figure here is going to be 8,008,000. Then on the earning side, 112 plus 18,210, and that would be 18,322. So we can calculate the earnings per share divided by 808, and that is 2.29. So that will be, if we want, the earnings per share here. But like I said, this is not dilutive. Okay, it's not dilutive. Because like I said, the preference shareholders, they are not going to be really having any impact on us on the profit in that particular case. So what is really the diluted earnings per share? So our diluted earnings per share is this particular one, the second one we did, which is the option and the convertible bond, 2.28 naira. And that is the answer to our question. Okay, so that was why I mentioned that we could actually ignore the convertible preference share situation, because really it's not dilutive. We are not going to be getting any impact on it on our profit. Yes, if they convert, it's likely our number of shares may go up though, but technically we are not going to be considering it. And this is the answer to the question, and that is how we apply the share options and then the convertible bonds as well in the discussion. So in respect of this particular question, you see that our basic earnings per share is $3 just from the presentation here. So we are telling shareholders that, hey, listen, right now you may be earning 3 naira, sorry, not dollars, 3 naira per share. But when the convertible bond holders and then the share option people, they convert, the position of the entity is going to be that you are likely to get just 2.28 naira per share. And that is a reduction in the earnings per share. That is why it becomes a dilution in that particular case. So that is what we must understand in respect of the earnings per share calculation when it comes to the diluted earnings per share in the potential issue. Now, if you remember this question, there was something else. Let me bring that to your notice. It says rank the potential ordinary shares. Now, when it comes to the potential ordinary shares, we spoke about this in the first episode. We rank them based on certain criteria. So let me pull up my slide on that and then just walk you through that principle of the ranking. So this is the principle as per IAS 33's guidelines on the ranking of the potential earnings per share. So procedure for ranking potential ordinary shares. So it says that when there are several types of potential ordinary shares in issue, they should be ranked in order of dilution, with the most dilutive potential ordinary shares ranked first. The most dilutive ranked first. So how do you determine which one is the most dilutive or not? Point number 2. In order to carry out the ranking, the earnings per incremental share is found for each potential ordinary share. This is the earnings adjusted that will be necessary divided by the number of shares that will come into being if the shares were included in the calculation of diluted earnings per share. What this simply means is that of the two, or when we are doing the ranking, which one really affects us? Now, if you go back to the question, always we're going to rank options as one. Always. Options will be ranked first. Why? Because options have no addition to the profit. So we will still be making the same profit, but the number of shares will go up. So there will be more dilution there. Now, then the second is going to be the convertible bond. That will be ranked second. The convertible bond. Why would that be ranked second? Because that one, we are going to be adding the net interest of the tax back to the earnings. So in a way, our earnings figure is going up a little bit, and then our shares is going up a little bit. So if you compare options and convertible bond, options will be more dilutive than the convertible bond. So that is the principle that we follow in terms of the ranking. So the option will be ranked first, the convertible bonds will be ranked second, and then the convertible preference shares will be ranked third. So that is the idea also about the ranking principle. Any questions? And that brings us to the end of diluted earnings per share. So let me know if there are any questions. You can put them in the chat for me. I see some of you guys joining. This is the part 2 of our IFRS masterclass focusing on IAS 33 earnings per share. Give us a thumbs up on the video, share the video as well. Let's reach as many students as possible. But most importantly, let me hear from you in the comment section. Any questions you have for me, something you would want me to share my thought on, put it in the comment section for me, and I'm going to be reading all your comments. I'm seeing some chats coming up. Let's see if I can look at them quickly, and then we share is $3. You can see that it is the 18 million divided by the 6 million that is giving us the 3 naira. So that is the basic earnings per share in that particular case. Um kind of questions you are asking, I don't get the context. In the question, the nominal value of the share was 50,000 kobo. Oh, sorry, 50 kobo here. 50 kobo. That's why you are seeing 50k here. 50 kobo. This is a Nigerian currency. So if we want the number of shares, it's the total value 3 million divided by 50 kobo, and that gives us 6 million shares. So that's how we got that as well in that particular case. I was muted on this particular slide. I didn't know that I was muted, so I got to go through the chat really quick again. Hi, watching from South Sudan. Okay. Then there was another thing said, how is the basic earnings per share 18 million? Like I said, we didn't calculate basic earnings per share to be 18 million. Basic earnings per share is 18 million divided by the number of shares, 6 million, making the 3 naira. So the basic earnings per share is 3 naira. That is why you are seeing this pro forma here. This is earnings, this is number of shares, this is earnings per share. So it's the pro forma of presentation that we are having here. And so the basic earnings per share is actually 3 naira here. Then also, how did we get 3 million by 50? Again, in the question, we were given the data in respect of how that is supposed to be done. We were told that the nominal value is 50 kobo. 50 kobo. Kobo is the smallest unit of the Nigerian currency. And so to get a number of shares, it is 3 million. Sorry, 3 million divided by 50 kobo, and that gives us 6 million shares. So that is how we got that as well. And then I think I read this also. I'm interrupted. What else? Okay. Yeah, so I just checked because I realized that I was muted on this particular scene. So Debo said, please take us through consolidated financial statement. Yes, we'll be looking at consolidated financial statement, but like I said in the part 1, what you want to do is to check the channel. You can check the playlist on the channel. We have what we call the consolidated masterclass on the podcast session of the channel, the consolidated masterclass. And so you can start going through that even before I get into my discussion of these on the live stream. Okay, so you can start watching that before we discuss it, because those videos there are equally relevant. The principles of consolidation hasn't changed, so they are applicable there, but we'll be covering some of the things in the, how do we call it, we'll be covering some of the things in our discussion generally as we continue. Okay, so let's see. I'm seeing another chart here. Will the 50k be 0.5 in naira in order to get a 6 million? Yes. That is why I said it's 50 kobo, not 50. Because if you say 50k, it's like you are saying 50,000. It's 50 kobo. So it's like 0.5 naira. So it's 0.5 divided by the 3 million divided by 0.5 to get that particular figure there. 3 million divided by 0.5, that is leading us to that particular answer there. Okay, so that is the idea about diluted earnings per share. If there are other questions, sorry, you put them in the chat for me, and I'm going to be reading your questions for you generally. So now that we've finished with the diluted earnings per share part, let's come to the basic earnings per share part and then discuss some few things as well there. So if you remember, we said under the basic earnings per share, there are 3 things there. We're going to be talking about right issues. Then we talk about bonus issue, and then issue at full market price. So let's come to the basic earnings per share and let's look at the scenarios that may lead us to deal with that. So basic earnings per share. Now, there are three scenarios like you saw a moment ago. So we're going to be going through a couple of them. Number one, let's start from right issue. So I want to start from the bottom and then we take it up into the discussion generally there. So what is the idea about right issue? Right issue is simply the issue of new shares to existing shareholders at a price below the current market value. So what does that mean? It means that if the average share price or the average share price is say $20, we would make a right issue, and that means we are issuing new shares to the existing shareholders, but we won't let them buy it at $20. They're going to buy it at say $10 or maybe $15 in that case. What does that mean? It means that they are paying less than they should have paid. And so there is a bonus issue there that we have to look out for. So anytime we are reading an earnings per share question and there is a right issue, quickly it is important for us to calculate what we refer to as the bonus fraction. Now, what is the bonus fraction? The bonus fraction is simply going to be the current share price. Okay, the current share price minus whatever they are going to be paying to us generally in that particular case. Sorry. The current share price divided by the theoretical X right price. I'm going to explain that to you in a moment. For those of you from the financial management class, you know theoretical X right price. Now, the current share price will always be given to you, but the X right price, you have to calculate it to be calculated. So principle number one, anytime there is a right issue, what do? We calculate bonus fraction. Because like I said, shareholders are getting some benefits. Instead of paying $20, which is a current share price or the average share price, we are going to let them pay like maybe $10 or maybe $15. So they are getting some bonus. The implication of that bonus would have to go into affecting the number of shares in existence prior to the right issue. So once we do the calculation of the bonus fraction, the principle is that the bonus fraction affects only shares prior to the right issue. That's a principle. So our bonus fraction is not going to affect the number of shares after the right issue. It will only affect the number of shares in existence prior to the right issue. So let's take a simple illustrative question, and as always, and then let's see how this rule will actually play out under right issue. So I'm going to take some pieces of questions like we did in the share option and the convertible loan notes, and then we put the pieces together generally. So let's see. Give me a sec. I thought I had opened this up, but it appears I have not. So let me go bring up my slide on this quickly. We go here, IFRS book. Let's go to earnings per share, and let's go a little bit down to page 305. There we go. So there's a simple question here. Let me take a screenshot of that. And then I'm going to use that as a guinea pig. Those of you with my book on financial reporting or corporate reporting, this is available in the book. But you can also take a screenshot here because it's equally available here. Okay, so what is the requirement here? It is calculate the basic earnings per share of Michin Limited if the part is $10 million for the year ended 31st December 2020. So let's read. Michin Limited had an issue $1 100,000 shares and made a right issue of 345. Made a right issue of 345. Now it's important you understand what that means. 345 simply means that we give you 3 new shares for every 5 existing that you are having. Okay, we give you 3 new shares for every 5 existing that you are having. That is very important. 3 new shares for every 5 existing that you are having. On 1st August 2020. Now, you got to be careful, because if you remember from episode 1, I told you that if somebody is having shares at the beginning of the year, and then during the year we issue some shares, and another person buys some shares, you don't expect the person who bought the shares partway within the year to have the same earnings as the person who was having his or her share at the beginning of the year. And so timing ratio is going to be crucial here in the calculation of the basic earnings per share. Always we will consider timing ratio. In the diluted earnings per share environment, we don't consider the timing ratio because we assume that the conversions are done at the beginning of the year. But when we come to the basic earnings per share, whether it is issue at full market price or bonus issue or right issue, we have to consider the timing, because that is going to play a key role in our calculation. Okay. So they did a right issue on 1st August 2020. Now stay with me. So it means that from 1st January 2020 to 31st July 2020, how long is that going to be? That's like 7 months, right? That 7 months period, the number of share in issue was the original share of 100,000. So that original share of 100,000 was there for 7 months. Then on 1st August, so now from 1st August 2020 to the year ended 31st December 2020, which is going to be 5 months ultimately, because at the end of the day it has to be equal to 12. So August, September, October, November, December, so 5 months ultimately. How many shares will then be there? Now from that time we are going to be bringing in the outstanding shares at the beginning of the year, which is going to be the 100,000. Then we bring in the right issue. Now, what is the right issue here? We said you get 3 new for every 5. So that's going to be 100,000 divided by 5 times 3. 3 new for every 5, because it is what? 3 for 5, right? So since it is 3 for 5, that's going to be 60,000. And so from 1st August to 31st December, the total number of shares there will be 60,000 shares. Are you following the picture? So that is the first thing we need to look out for, the timing ratio of the shares, because that will feed into the way we calculate the weighted average number of equity shares under basic earnings per share. That's very important, under basic earnings per share. Very important. Okay, so now that we have this, let's continue to read the question. They did a right issue at 4.20. Now remember, we said anytime there is a right issue, we have to calculate the bonus fraction. And so we go back to the question and bring in the bonus fraction, which is our current share price, which will always be given to us, divided by the X right price, which we said we will have to calculate. the X right price, which we said we will have to calculate. And so the current share price is given to us in the question. If you remember, they said the share price at the date of the issue was $6.50. But what is the X right price? We have to calculate that. And like I said, if you remember what you did in financial management, for those of you who did financial management, you know how to calculate the X right price. But we have to calculate that. So let's do the calculation for that. The way we calculate the X right price is simply to just apply a concept to be able to calculate the X right price. The X right price is like the new share price after the right issue. But it's theoretical because that is not what will happen. So that is why it is called theoretical X right price. So usually that is going to be lower than the current share price always. But how do we go about it? This is how we go about it. We'll just have shares here. We'll have the value there in dollars. So currently, when we own 5 shares, it will be valued at $6 per share. So 5, what's the share price? 6.50. So what do I have? Let me push my value here a little bit. So 5 by 6.5, that's 32.5. So currently, because remember the policy is 3 new for 5 existing. So the 5 that you are currently having at 6.5 will be 32.5. Then in the right issue, you get 3 new shares. That is valued at $4.2 per share because that is how much they paid for the right, for the new shares that they are buying. So 3 by 4.2, that's 12.6. So we add it up, this is 8. Add it up, 12.6 plus 32.5, that's $45.1. So once we have this $45.1, we can then calculate the theoretical X right price. I have a luxury of space, so I can just be moving around my slide a little bit just to make me comfortable in what I want to do. So our X right price becomes the total value $45.1 divided by the total number of shares, which is 8. So 45.1 divided by 8 becomes $5.6. So that's our theoretical X right price, 5.6. Okay? So now we have the denominator, the X right price. So now our bonus fraction is going to be the 6.5 divided by 5.6. Now don't punch it to get a final answer because you will apply it to the calculation of the weighted average number of equity shares. But this is what we do so far. So again, let's go through that again. The first thing we did was to find out about the timing ratio. How long has the outstanding shares from the beginning of the year be in play before the end of the year? How long? We bring that up. That's the first thing. Number 2, the right issue came. How long is that also going to be? We bring that also up for the period under review in respect of that. Then, because it is a right issue, the rule is we have to calculate a bonus fraction. Why are we calculating the bonus fraction? Because of what we said, that we are issuing shares to the shareholders and they are buying the shares at a price below the average share price of the entity. And so there is some free elements there. And so that bonus fraction would have to be calculated because of that free elements that they are getting. Now that we have the bonus fraction, remember the rule we mentioned here. We said bonus fraction affects only shares prior to the right issue. So now let's calculate our weighted average number of equity shares. Now the way we calculate our weighted average number of equity shares is to simply go in here and then bring up the various issues. So what I'm going to do is to just present you with something very simple for you to understand the pro forma. So we're going to have the outstanding shares. Then we will have the timing ratio. Then we'll have the bonus fraction. Then we'll have the average at the final column. Okay, stay with me. Now, like we established earlier, from 1st January to 31st July, we were having 100,000 shares outstanding. The timing ratio was 7 months. And so it's going to be 7/12. Bonus fraction, which we calculated here, 6.5 divided by 5.6. We punch that out and that gives us the average. Remember, we are multiplying everything to get the average. So the average is equal to the outstanding shares multiplied by the timing ratio multiplied by that particular figure there in that particular case. Give me a sec. I think there is another moron like that in my comment. Let's see if I can quickly deal with that real quick. I don't know why some people always will want to misbehave. Okay. That's better. So we punch that out now from 1st August 2020 to 31st December 2020. Remember we said, what's the number of shares we now have? 160,000. And that's going to be 5/12 for the timing ratio. But remember, no bonus fraction will come. Because remember the rule we established. We said bonus fraction will only affect the shares prior to the right issue. The shares before the right issue. So bonus fraction doesn't come again after we do the right issue. So let's get the figures coming up. So we're going to have 100,000 multiplied by 7/12 multiplied by 6.5 divided by 5.6 bracket close. I'm getting 67, maybe 708 as my figure there. Then we punch the second one, 160,000 times 5 divided by 12, and that is 66,667. So that is how we calculate the weighted average number of equity shares when there is a right issue. All right. And so 67,708 plus 66,667, and that is 134,375. 134,375. So now that we have calculated our weighted average number of equity shares, we can then calculate our earnings per share. So our basic earnings per share will be equal to the profits that the entity made, which is $10 million, divided by the weighted average number of equity shares we just calculated, 134,375. So 10 million divided by my answer, I'm getting $74.42. So this is how we deal with basic earnings per share when there is a right issue. I hope you get the principle. This is how we deal with basic earnings per share when there is a right issue. Very sweet, simple, and straight to the point. So again, let's go through that. Number one, let's get a timing ratio for the outstanding shares. Number two, because it is a right issue, we have to calculate bonus fraction. And the bonus fraction is your current share price, which will always be given, divided by the X right price, which you would have to calculate for. To calculate the X right price, you just apply the issue that we're given, the conversion, the right issue situations given in the question. Currently, we own 5. At 6.5, the current share price, what do we get? Under the right issue, you get an additional 3. At what price? 4.2. And so when we divide, that gives us the X right price. Then we can then calculate our bonus fraction. But like I said, you don't want to punch this out. Okay, you don't want to punch this out, because when you punch it out, you're going to start to approximate data, but we don't want to start approximating anything. So we're going to use the bonus fraction in its raw form like that in the calculation of the weighted average number of equity shares. And the key principle about the bonus fraction is that it affects only shares prior to the right issue. Hence, in the calculation of the weighted average number of equity shares, you are seeing the bonus fraction coming in here. But after the right issue, you are seeing that there is dash there under the bonus fraction, because the bonus fraction will no longer be affected in that particular case. And that is what you must understand when we talk about basic earnings per share and we are dealing with right issues. Any other questions, you put it in the chat for me. So it starts from here, Michin Limited. This is where it starts from. And then we come here for our bonus fraction calculation for the period under review. And then suddenly we now calculate the basic earnings per share. So again, what I want you to understand is the principles. Everything we are doing is about principles. If you look at what we did in the diluted earnings per share and the full question we solved, it's just principles. Principles. So you have to make sure you understand the principles very well, because that is the only way you can position yourself to pass the examination. So when you understand the principles, then you can now expose yourself to a lot of questions, and that is how you pass the examination. So let's see. Alan from Zambia. Okay, thanks for joining us on the stream today. All right, so that's the idea about the basic earnings per share calculation. And I'm going to be wrapping up here for today, so that on Friday we can look at the final two, which is the issue in respect of bonus issue and then issue at full market price. Then we will be done with the standards. So once we go through these principles, you will then be in a better position to expose yourself to questions and solve some questions. But now that you've understood the principles, you can then start exposing yourself to questions that will be having diluted earnings per share, or questions that will have the right issue in the mix, and then see how you follow the principles. It is the principle you must No. Once you understand the principles that underline the standards, that underline the concepts, like, you'll be good generally in that regard. So that's it about that. And God willing, Friday at 4:30 p.m. GMT, I'll be coming your way as we wrap up on this particular beautiful standard IAS 33 with bonus issue and issue at full market price. And then definitely we will start with another accounting standard on Friday as we continue with the discussion. So stay safe, and I'll catch you on Friday, God willing.